And now I would like to introduce today's speakers. Amy Seapluck practices in the executive compensation and employee benefits areas. She regularly advises public and private companies and not-for-profit entities on their executive compensation arrangements, including on equity awards, deferred compensation plans, non-qualified supplemental plans, and executive employment and severance agreements. Ken Hallett focuses his practice on securities law, including offerings, continuing disclosure and compliance, and corporate governance, as well as mergers and acquisitions. Until recently, Ken served as national chair of our firm's business law group. With over 35 years in practice, Ken brings to the table the experience, skills, and tools needed to be a go-to lawyer for clients navigating business law, securities, and M&A opportunities and challenges. Ken represents clients in numerous industries, particularly manufacturing, technology, and financial services. Robert Lewis is a member of our executive compensation and employee benefits and business law practice groups. Robert has extensive experience working with private and public companies in domestic and international equity plan design, implementation, and compliance. He also advises companies on global equity chargeback programs, executive employment contracts, executive compensation proxy disclosures, severance plans, and retention pay programs. He is well-versed in compensation and equity issues associated with M&A, initial public offerings, spin-offs, and other corporate restructuring. And now I'll turn it over to our speakers.
Good morning or good afternoon, everyone, depending on where you are. I'm Amy Seapluck. After that intro, I'm thinking I really should have beefed up my portion. There's some impressive credentials there, but anyway, just wanted to kind of kick things off and lay the groundwork for what we will be talking about over the next just under an hour. And I know that we have attendees here today, either in person or via webinar, who represent really all types of businesses and organizations. We have people who are from public companies, people who are from private companies, and people who are from nonprofit organizations. The one thing that you all have in common is that all of your businesses or organizations pay executive compensation, and you all know that people care very much about that executive compensation. Now, from there, there's a little bit of a divergence in that there are certain rules and regulations that apply only to public companies, certain rules and regulations that apply only to not-for-profit companies, and some rules and regulations that apply to all of you. So we're going to be hitting on pieces that unfortunately might not be applicable to all of you, but I promise we'll cover some things that apply universally, and we'll make sure that we call out when we're talking about a particular rule, you know, if it only applies to a limited group. So the things we will be covering today: some developments in the Dodd-Frank arena, some developments with Code Section 409A, which regulates deferred compensation, a couple of reminders on some tax rules, and hopefully ending, time permitting, with a brief discussion of some other developments in the public company executive compensation arena. So with that, I am going to turn it over to Ken Hallett, who is with us in sunny Naples today.
Thank you, Amy. I was trying to get some palm trees in the background, but somehow we couldn't get them into the conference room. And the other point on sort of having the long resume and little bio, you know, it's a mixed blessing. So, for example, all my years of experience just prove I'm old. But in any event, good afternoon, good morning, everyone. I'm going to start this off by talking about a development that has arisen under the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, otherwise the Dodd-Frank Act, that has a fairly narrow initial application. But it's something that I think, you know, we all look in our crystal balls and see affecting companies well beyond the immediate sphere that it will start out in, which is financial institutions, into public companies, private companies, and other kinds of companies. So let me step back for 1 second and give a bit of background here on Dodd-Frank. It was a piece of legislation, for anybody who's not familiar with it, passed coming out of the Great Recession of 08, 09, and the beginning of 10. Among other things, the Dodd-Frank Act, and probably primarily, was intended to reform the financial institution industry. But one of the subcurrents at the time of Dodd-Frank was that there was way too much endemic risk in our financial services sector, as well as in the economy generally. And one of the things blamed for that risk was executive compensation. The feeling was that too many professionals in this area, in other companies, were compensated based on taking a lot of risk, and that needed to be regulated more sternly. Frankly, I think there was also a fair amount of simple envy about the levels of executive compensation, which were fairly high in some industries, and there was a certain amount of ex post facto punishment. So, Dodd-Frank created a host of related provisions dealing with endemic risk, dealing with compensation, and dealing with other protections, not only in the financial institutions industry, but for the economy generally. Some of these things were very tailored and focused on the specific problems that led to the recession, and others were just more general, were more feel-good, or were just plain old punitive. So, Section 956 of the Dodd-Frank Act. The Act itself requires the United States financial regulators to create rules and promulgate them affecting incentive comp at financial institutions that encourage inappropriate risk-taking, again, at covered financial institutions. And by the way, there's going to be a lot of defined terms here. There's no quiz, but I'll go through them a little bit later. The first set of rules were proposed very shortly after Dodd-Frank was adopted in 2010, but there was a major rewrite of the proposals in mid-2016. Supposedly, this rewrite was to reflect latest actual practices of financial institutions, questionable, and to align with rulemaking by foreign regulators, some degree of truth to that one. Compliance, just so you're not worried about anything we're talking to coming into effect, say, tomorrow, will be approximately a year and a half out from when a final rule is adopted. It will not affect compensation arrangements that are in place before the compliance date. The rules have not yet been finally adopted. They've not been promulgated. We'll talk a little bit later about what the calendar is or isn't on that. But the very earliest any of this could apply would be for beginning for periods in 2019. So Ed, can you go to the next slide, please? So let's break for 1 second here. You say, okay, Ken, this is all very nice. We're talking about financial institutions. I'm not with a financial institution. I don't represent financial institutions. Why, other than perhaps a nice lunch and some CLE credits, am I here? Well, yes, it is initially limited by its terms to financial institutions, and for that matter, large financial institutions, which we'll see in a bit. But it's frankly likely to affect other companies down the road sooner or later, but probably sooner. So, for example, anyone with a public company knows that we are now subjected to regular, usually annually, stay-on paid advisory votes from our shareholders. That began in the financial institution arena as a requirement for any company to receive TARP funding. And is spread to the economy at large. Some of these rules are going to change vocabulary a little bit. And we'll talk about some of those later. But even if you're not in the financial institution industry, or for that matter, not even with a public company, you may be finding the way that your consultants or others talk about compensation starts to vary a bit. Maybe most importantly, these may start changing the perception of what best practices are in compensation, whether it's in the financial institution industry, whether it's for public companies more generally, or even for private companies, say from your lenders or private equity sponsors or other owners. or your outside board directors may think differently about what a good practice is. So I'll give you a for example on that one. Some of the post-vesting holding rules that we'll talk about later, a version of them has been in effect in the United Kingdom for multiple years, since I think slightly prior to the recession. But the rules and regulations only specifically apply to financial institutions. Well, I just saw a recent statistic preparing for this, that over 70% of companies in the UK, or at least public companies, now have these same kind of provisions in place. So it's a developing best practice. And relating to that, especially for public companies, we're likely to see a lot of institutional pressure from our shareholders, from do-gooder organizations like ISS, that is just going to change. So let's move on a little bit to, so what are the specifics of the new requirements? Add the next slide, please. So first of all, so that most people can go home sleeping at night not thinking this is going to immediately affect them. Covered financial institutions are classified according to their total assets. And many of the requirements we're going to talk about only will apply to level 1 and level 2 organizations. So as you see from the slide, $50 billion or more in assets. Now, I think that probably will take out pretty much everybody in the room. For example, in Wisconsin, I don't believe we have any financial institutions headquartered there that are $50 billion or above in assets. And I apologize if I'm forgetting somebody. Some of the requirements apply above $1 billion. But again, initially, this will be for larger institutions. But again, think about the creep that we think is very likely to happen. So, a couple more definitions. These institutions will be required to subject qualified incentive takers, or excuse me, qualified incentive-based compensation for its senior executive officers and significant risk takers to 3 main provisions: deferral of payments, risk of downward adjustment, and forfeiture, and clawback. And we'll talk about what all of that means. Now, a couple more definitions. Senior executive officers. For those of us who work a lot in the public company realm, we know who our senior executive officers are for SEC purposes. The CEO, the CFO, heads of large departments or organizational functions. Senior executive officers under these regulations go much, much farther. So, for example, in the financial institution realm, it's senior credit officers, senior risk officers, audit, investment, compliance, accounting, heaven forbid, legal. So pretty much anybody who handles a major function of any kind, whether or not we consider them an SEC executive officer, would be covered. And the requirements go beyond that to significant risk takers, which is based on a series of very complex definitions that key to compensation and exposure. So bottom line is the ability to expose the institution to risk. So just to use a bank example for a second, you have a lending officer, not the chief lending officer, but your basic banker who can expose the bank, who has a credit lending limit of, say, $20 million that he or she can approve. Depending on the size of the institution, that may expose the institution to significant risk. So a person like that, who's just a, no insult intended to anyone, run-of-the-mill lender may well be covered by this. So it goes pretty deep. For anybody who happens to be listening, who's in a smaller financial institution but not level 1 or 2, there are some other basic prohibitions that would apply, which we'll talk about again later, in its governing, but the governing agencies in all of these have the ability and discretion to determine how to apply the rules. So for anybody who is in a regulated industry, whether it's financial institutions or not, you know how much power the regulators can have to come in and interpret things and how uncomfortable that can be. So again, initially applies only to very large institutions, but it's likely to go beyond. And Ed, I'm sorry, I should have told you before to advance, and now let's advance again. One more. There we go, deferral requirements. So let's talk a little bit substantively about what the new rules will require. First, deferral. there's now a requirement for deferral of a portion of all incentive-based compensation that is awarded to a senior executive officer or a senior risk taker. Okay? So, again, you ask, what is incentive-based compensation? It's any variable compensation or fees or benefits or bonuses that serve as an incentive or reward for performance. So, okay, let's come up with a couple examples. What's not incentive comp? Base salary that you get for showing up. A signing bonus for a new officer you're hiring. Something that vests, such as restricted stock based on longevity or continued service. What is incentive-based compensation? Stock options. Performance shares that will vest according to a company's performance on pre-established metrics. Bonuses that depend upon pre-established metrics, company-wide or division-wide. Phantom stock. Anything essentially that has a performance component about it is subject now to some mandatory deferral. Okay. What do I mean by that? The amount of deferral will vary depending upon whether the compensation is short-term, a year or less, a performance period, or long-term, okay, and the kind of person involved. But essentially, it can require up to a deferral of up to 60% of any earned incentive-based compensation. So, for example, if you're a senior executive officer at a level 1 institution with short-term comp, you would be required to defer if you earn, let's say, a bonus based on performance of $100,000. You would be required to defer 60% for 4 years. Substantial deferral. By and large, the lower ranked an officer is, or the lower the institution is, the lower the deferral percentage will be. Also, for long-term compensation, the deferral is somewhat less. I think because it's a longer compensation period, less subject to playing around with. The deferrals, by the way, are from the time of the award. And this is a place where the terminology changes slightly. Notice I said they're earned in the performance period before. Well, under these regulations, that when they are earned is now the award, which is what we usually have thought of as the day the board of directors or the compensation committee says you can't earn this. So what we used to think of as vesting under these rules is now an award. So just back to your mind, if the terminology starts changing, this may be a place where it comes from. Next slide, please, Ed. So what are some related rules? Awards that are subject to deferral can vest during the 3 or 4 or 2 year deferral period, but not faster than pro rata on an annual basis. So, for example, our example before, our officer who was required to defer $60,000 worth of compensation, it could be paid to her $15,000 a year for 4 years. Okay. Deferrals must include both equity and cash. Can't be disproportionately in one or the other. So, let's say, for example, that you have a long-term award and it's based, they're paid 50% in stock, 50% in cash. The deferrals must all be more or less 50% of your stock and 50% of your cash. You can't defer only your stock and take all your cash up front. We'll see a little bit later that may cause some interesting little tax issues or interesting big tax issues. Options may not represent more than 15% of the required deferral. Why did they pick on options? There seems to be a simple dislike at the regulator's level of options. That somehow there's this view that if you're focusing for, say, a public company on market performance, that is somehow more suspect than focusing on internal business metrics. That they're therefore somewhat more susceptible to risk. It is simply a matter of regulatory wariness. by the way, of course, if way more than 15% of your executive pursuit incentive-based comp is in options, and you can only defer not more than 15%, that will create additional dislocations in what you can take up front in cash versus what has to be deferred. So I think it will be a bit strange. Deferrals can accelerate only on death or disability. Notice not on change of control. So, is there any benefit to these rules? Well, maybe from the company's perspective, it could reduce compensation expense depending upon how the auditors view it for financial statement purposes. But because it spreads expense out over a period and/or creates a certain amount of risk, it may reduce compensation expense. That would be a benefit for the company. The company may also get, by the way, and we'll talk about this a bit later, governance brownie points, for lack of a better word. As ISS or institutional investors are evaluating compensation practices, the deferral of compensation may be the kind of thing, and is frankly likely to be the kind of thing, that those organizations will see as beneficial to shareholders and good practices. Flip side, tax issues. And if I talk too much about taxes, I will get to a point of complete coherence, but I'm going to sort of keep this at a high level. But the mere deferral is not likely to delay taxability of these awards. So you may be in the situation now, of course, where your executive is required to defer 40, 50, 60% of her awards, has to pay taxes up front, has to be pro rata cash versus equity. There can be some substantial withholding obligations and tax payment obligations in excess of cash to be received, or potentially in excess of the equity that can be received up front to either be sold or turned into the company. It's a problem. I don't think the regulators have seen this as a problem for them to solve. But as compliance begins in earnest, and perhaps in response to comments they've received as regulations are finalized, these will be addressed, but they are simply, it is a problem to note and to be aware of as these are finalized. Okay, Ed, the next slide, please. So what are some of the other things we need to deal with? Number one, there's a risk of forfeiture or adjustment. So if there are certain defined risks or failures, this deferred compensation is subject to either forfeiture or downward adjustment. Okay, what do we mean by those terms? Forfeiture is a bit what it sounds like. After the performance period ends, if there are risks or failures, and we'll talk a little bit about what that means, the company can take the compensation back. That's exactly why we deferred it, to make that somewhat easier for the company. The awards are also subject to downward adjustment even during the performance period. That creates a substantial risk and disincentive, because at some point the board of directors of the comp committee is going to be required to have the ability to, in the midst of a performance period, adjust promised bonuses, promised equity awards and such downward to reflect bad things. Okay, so now what's bad? What are the bad things we're talking about? Number one, inappropriate risk taking. Well, that's clear, isn't it? And of course, it's clear as determined by the regulators looking over the shoulders of the institutions, perhaps in hindsight, and who are not probably as well compensated as your average outside the person in private industry, and who may have their views about what's appropriate compensation that somewhat differ with any of ours. They can be clawed back or forfeited, or downward adjusted or forfeited for regulatory noncompliance. May have nothing to do with the earnings metrics or not. Can be adjusted downward or forfeited due to control failures or risk management failures. Again, all of these are very subjective tests, which are not going to make the executives receiving this compensation sleep well at night, knowing that the requirements are out there. They're very subjective by the company and by the regulators. These are not, as say with the public company clawback rules, merely in a situation where, say, a financial statement restatement is required. There's a huge subjective element. And I somehow suspect people even beyond me are troubled with the idea of regulators deciding all of this. Okay. And on clawback, even after the deferral period is over, and by the way, the deferral period is over, that is termed in these regulations, the vesting. So now what we used to think of as vesting is the award, and what we used to think of as, well, we used to not think about it because people had their awards by this point, but by the time the deferral ends, is the vesting. For a period of 7 years thereafter, comp remains subject to clawback. Even if there was a pro rata distribution during the deferral period, it keys from the end of the deferral period. It's longer than the SEC requires. And as we've seen before, it's for events that go well beyond what the SEC might demand. Now, again, how much of this makes it into other industries, private or public? Well, you can easily foresee that institutional shareholders, the proxy advisors with some clout may try to import it there. In the private world, it may be longer to get there, but again, it may be there. So just a couple of other things real quickly. Add the next slide. Some additional provisions and these prohibitions, and these apply to all the financial institutions, not just level 1 or 2. Neither the company nor the covered people can hedge the deferrals. So you've got to stay at risk. There are maximum amounts now established of incentive-based compensation opportunities. Generally now are going to deem the maximum of 150% of target comp. Just as an aside, if there are any other cynics in the room, how many of us think that the targets will now start going up? Okay, what we will see. It creates certain standards for performance measures. So cannot rely solely on relative measures. For example, TSR, which is a very common measurement for incentive comp, and cannot rely solely on transaction revenue volume without regard to transaction quality. So, for example, maybe many of us will think right now of the Wells Fargo example, where the CEO, resigned, and there was significant problems because of the incentives to create a volume of new accounts and compensation depending on that. Would be prohibited. Requires additional risk management and compliance systems because apparently there aren't enough already, and mandates for financial institutions an independent compensation committee which must receive input to evaluate risk. Personally, when we had the accounting scandals of the late 90s and early 00s, somehow the accounting scandals led to a boon of work for accountants. Compensation scandals in the late 00s scandals led to a boon for compensation consultants. Perhaps we will now have our boon for risk consultants. Again, not to be a cynic or anything. So next slide, please, Ed. So what are some of the practical consequences? Okay, number one, obviously, if you are a covered financial institution or a company that becomes subject to scrutiny by institutional shareholders and such, want to look back and see on our plans and award agreements to make sure that they comply, or at least maybe structured to gain additional scoring points from the rating organizations based on these kinds of factors. Okay. Number two, financial institutions certainly, but perhaps others, need to create more effective processes to evaluate risk and to factor that risk into compensation. In the SEC world, we now need to talk about that and disclose, but there may be additional substantive requirements. Some other questions. If I were executive, perhaps would I request more non-incentive-based pay? As we've had all the increasing move to pay based on performance, now suddenly we're penalizing pay based on performance. How about good old salary? again, how much of this will now serve not only as a requirement for financial institutions, but as now the expectation for institutional shareholders or governance groups? You know, how will it be modeled? And if ISS does the modeling, how will we ever figure that out? And perhaps the $64,000 or $640,000, depending on comp, question is, how will this fare in the new administration? You know, these rules are still pending. They're installed under Obama. There were many rules under Dodd-Frank still pending. There's been a push over the last several months to try to clean up some of the rulemaking, but obviously we're going to have a bit of a change come a week from tomorrow. And there are already significant pushes in Congress to repeal parts of Dodd-Frank. I'm not sure that this is what Congress people have in mind as their first step, but it remains to be seen. But the bottom line is this genie is out of the bottle, and particularly in terms of how this may shape the discussion of what is best practices, it's out there, and it's something that well beyond the financial institution world we need to be thinking about. And with that said, I'm going to turn it back to Amy and Robert.
Good afternoon. 409 Cap A. It was Congress's answer to make sure Enron never happened again. And as you all can remember in Enron, it gave the executives the ability to take their deferred compensation and run. And so what happened is Congress came up with this really complicated area called 409 Cap A. And basically, at its basics, 409 Cap A requires that if a party is going to defer compensation, it must decide right then and there when it's going to be paid in the future. And it also must make sure that it's compliant with that throughout the whole entire process. And if you're not compliant with that, there's violations and penalties. And so the employee would actually recognize the income immediately and pay a 20% interest on the amount that was deferred. And I think going through 409A, if you read the definition of deferred compensation, it's really kind of doesn't make a lot of sense. And the way that I've always remembered is in its most simplistic form is a paycheck example. Imagine you go into your boss's office to get your paycheck, but everything's going well that week and you don't really need it. So you say, just go ahead and hold on to that, and I'll come and get it next week or the next month. Right then and there, because there's no substantial risk of forfeiture, you've deferred that compensation. And then you need to start thinking about 409A. 409A kind of goes inside with a lot of the plans that a lot of the companies have. It works with certain foreign plans, stock rights, split dollar. But really, what I have found in the practices is deferred compensation can come up really when it's not even expected. It can come up in employment agreements. It can come up in option plans. It can really just kind of come up and you not even realize it. I know there's a lot of non-for-profit individual companies here as well, and so you also want to make sure that you're compliant with 409A, along with making sure that your 457F plans are compliant. And so when this first came out, everybody was just like, what is going on? This just doesn't make much sense. And it didn't make much sense, and so we haven't really had a lot of guidance on it. But the one thing that is important to understand is there are some exceptions to 409A. Now, it's not required. You can have deferred compensation, but if you're going to have deferred compensation, you have to make sure it either falls in one of the exceptions or make sure that you're staying compliant with it. And one of the most exceptions that we use is the short-term deferral exception. And so that basically means that if income that is earned in the current year must be paid by March 15th of the prior year. And if you satisfy that exception, you're completely out of 409A, where you don't have to deal and work with the complicated issues. There's also involuntary severance payments. If your severance payment is less than $540,000, you're also exempt, and other things. So we haven't really had much guidance on 409A. And kind of just a little history of how this kind of came around. In 2007, they actually defined non-qualified deferred compensation, and then in 2008, they issued the proposed regs on the amount that should be included in the penalties for 409 Cap A. And then since then, it's just really been silent. We haven't really had much. And then in June of 2016, the IRS came out with some proposed regulations which kind of clarify some of the stuff that, some of the issues and things that we've had with dealing with 409A. That's kind of the brief history of 409A, and now I'll turn it over to Amy to go through the proposed regulations.
Thank you, Robert. So I should start by saying that these rules under the tax code, they apply to deferred compensation arrangements, just to make it clear, of any type of organization. As Robert mentioned, not-for-profit organizations get this special treat of having Code Section 457F layered on top. So they, every time a nonprofit is looking at deferred comp, they have two really tax pieces of compliance. The rest of you, 409A, but this is one that hits everybody. And you know, it's funny, in many ways there hasn't been a lot of guidance, but initially the regulations and things that Robert mentioned were hundreds of pages long. So there's a lot out there, but there's still, there was a very long period of time where nothing happened. It was silent until recently, and I'll talk about what happened recently. And the other thing is, when you have that volume of regulations out there, you know, it's tough. It's a tough world to navigate. This has now been fully in effect for more than a decade, and this is still one of the top areas where I get questions from clients who are, you know, not sure if they can make a payment at a certain time, if they can make a change that they want to make to a deferred comp arrangement. This is still one of the top areas where I pop my head in a colleague's office, Dave Olson, sitting in the back of the room here, for example, and say, hey, can we just talk this one through? So this is a tricky one. So don't, I just say this because you can't forget about it. I think it's really easy to inadvertently violate it, and that's why we're still talking about it as over a decade later, and quite frankly, why in many ways it still feels new, because there's still so much to figure out. So what is truly new? Well, last summer, the IRS issued proposed regulations, and they cover a fairly narrow universe of issues. They don't necessarily tell us anything that's brand new. There were no like, whoa, this is, you know, completely different than what you said before, IRS, but they're more of clarifications, and some of them are pretty helpful. And these regulations, even though currently proposed, can be relied upon now, and I would say generally should be followed now. So let's just talk about a few of the key clarifications and pieces of guidance from these regs. Not going to cover them all today. I've probably put you all to sleep. But let's start with one that it was kind of interesting to me. At first I thought, why is this necessary? Payment, what does it mean to make a payment of deferred compensation? I mean, to me that seems really obvious. You pay, you give the employee money, right? That's a payment. Well, it turns out that some companies were maybe trying to get cute or thinking about trying to get cute, and when they had deferred compensation arrangements subject to 409A that called for payment to occur on a certain date, they'd have, you know, executives come in and say, I don't want this, I don't want to pay taxes yet. I'd like to defer it further. Well, 409A doesn't really let you do that. I mean, for the most part it doesn't, or it's so onerous in how it lets you do it that it's not worth it. So there was some talk about the possibility of making payments in the form of a non-taxable benefit. The two examples that the IRS gave are payment in the form of restricted stock or payment in the form of stock options. So if an employee was due $200,000 under a deferred comp plan, could you give that employee $200,000 worth of restricted stock or $200,000 worth of stock options? The answer is no. The IRS said payment means a taxable event. If you're trying to make payment in the form of something that isn't currently taxable, that's not a payment, and you're probably violating the plan or your arrangement. Next one, death. Death is another one where I've seen a fair number of questions over the years. Okay, we have a participant in our deferred comp plan who died, what now? You know, maybe you've got a plan that calls for installments, beneficiary doesn't want to wait, etc. The IRS gave us a little bit of guidance here. Nothing, again, earth-shattering, but there are a few things that they said. They said, one, that, oops, I'm actually starting, I'm going to go here and then back up. They said that if your plan says that payment will occur, you know, immediately following the payment to beneficiary will occur immediately following the participant's death, or, you know, within 3 months following the participant's death, the IRS gave a little bit of relief and said, in that instance, as long as the payment actually occurs by December 31 of the year following the year of death, we'll treat that as a payment on time. And this is one I've seen, you know, kind of play out in real life. When people die, you can't always do things quickly. You know, maybe if it's someone who's been gone from your company for a long time, they might not notify you immediately. You know, sometimes you're dealing with a widow or a widower who isn't giving you the information you need. And so that's a nice piece of relief in that it gives companies some time to sort things out when a participant dies. Just a few other quick points on death. The IRS, there are rules that allow change in payment timing when certain events occur. So for example, a plan might say payment occurs upon a participant's termination of employment, or if earlier upon the participant's death. And that's always been very clear. That was clear under the initial wave of regulations. What hasn't been clear is, what if a beneficiary is receiving payments, so a deceased participant's spouse or child or whomever they named, and that beneficiary dies, or that beneficiary becomes disabled. And the IRS clarified that you can have those same types of accelerations if a beneficiary has what the IRS calls an intervening event. So for example, a plan could have a provision that says if a beneficiary is receiving installments and becomes disabled, the beneficiary can get paid out in a lump sum. Or if a beneficiary is receiving payments and dies and there's going to be another beneficiary in line, that person can get a lump sum, kind of end it. So those are not, you know, those won't come up all that often, but at least now we know where to look if they do, and we have some rules that tell us what to do. Okay, next piece of clarification, correction of unvested amounts. So there have been rules kind of all along that say if you have an arrangement that's subject to 409A and there's a flaw with it, it calls for an impermissible payment event. You know, it says payment will occur if the executive's child goes to college, just as an example, where, you know, you can't have that type of kind of contingent event. If the dollar amounts involved are not yet vested, you are permitted to correct that. And that's been the case all along. What the IRS really clarified is kind of an anti-abuse piece of this. And they made it very clear, just because this doesn't mean that anything that's not vested, you can start tinkering with it. You can't, you know, say, well, it's not vested yet. So we said in the agreement we were going to pay it in 5 years, but let's change it to 10. Or we said we were going to pay it in a lump sum, but let's change it to installments. The only way you can use this unvested rule is if there's actually a 409A non-compliant provision in the agreement. And so they're kind of saying, we're going to be on the lookout. You can't use this as an excuse to start tinkering. You actually have to have a problem with your arrangement or your plan in order to use this unvested amount correction. Just a few other quick highlights. One of the permissible payment events under Code Section 409A is a separation from service, which for the most part is a termination of employment as we think of it. The IRS did clarify how you apply the separation from service analysis for what they call a dual status employee. So the easiest example of that is, what if you have an executive who retires, who's participating in a deferred comp plan, and she retires and the plan says, you know, payment commences or occurs in a lump sum upon a separation from service, but then you immediately bring her back as a consultant, as an independent contractor. Did she have a separation from service? Do you make payment? And what the IRS said is you apply sort of the traditional separation from service analysis, which as a kind of, to put it in the simplest terms, if someone's hours drop below a certain threshold, they've had a separation. There's some leeway in defining that, but a pretty common way of doing that is 20% of historical hours. So applying that, if you had an executive in your deferred comp plan who retired, came back as an independent contractor and worked, you know, 5 to 10 hours per week, that is probably less than 20% of his or her historical hours, and that person would have a separation from service. In contrast, if you brought someone back as an independent contractor to work, you know, 30 to 40 hours per week, then that person probably hasn't had a separation. I think just 2 quick points about this, maybe practical points. You can't flip someone to an independent contractor in order to go ahead and make a payment or to avoid making a payment. It's going to all come down to, are they still providing services for you? And then just a tangential, non-exec comp specific comment. If you have those kind of moves from employee to independent contractor or consultant, just be careful. There are a whole host of issues that come along with that. Employee classification issues. Are they entitled to commence pension benefits? Are they entitled to take 401k distributions or 403b distributions? So I just have to add that because I see that a little more perhaps than I would like to, and it seems to really cause problems for a lot of companies. So just keep that one in the back of your mind. Termination and liquidation of a plan. Bottom line, if you want to terminate a plan that's subject to 409A and accelerate payments, you really need to look into it, and you need to, the rule is, terminate all plans in the same category. And the clarification from these proposed regs was, there was an argument under the prior guidance that maybe you only had to terminate the plans covering the same people. No, you can end up having to terminate multiple plans at once if you want to terminate any. So that's one. If you're going down the termination route, plan termination, it's probably worth digging into. Last, just quick clarification. There's this was in one of Robert's earlier slides. There's an exception to 409A for involuntary severance if it's limited to not more than 2 times pay or another specific dollar limit. And the IRS clarified that if you happen to have someone who's hired and terminated in the same year, you can still rely on that exception. That just wasn't entirely clear under existing guidance. All right, so Robert is going to just quickly hit on a couple of tax reminders. He will turn it back over to Ken for a few wrap-up items, and then just so everyone knows, we'll leave a little time at the end for questions. So if you have questions that you haven't submitted, please feel free to do that.
Thanks, Amy. Section 280G and 162M. Section 280G is probably one of my favorite code sections to work with because it's got a cool name, golden parachute. But basically, as you guys are probably aware, golden parachute packages, when two companies merge on a change in control, there's normally two CEOs, and one of those CEOs gets terminated or separated. The amount of money that can actually be distributed to him falls under 280G. And basically, then a small portion of what happens in 280G is you take the last 5 years, and you take the average, and then you can times that at most by 2.99. And that is the amount that he is able to get under the golden parachute rules. There are some blended rules where you do the calculation of the executive severance, and after paying the 20% excise tax, if he's still coming out higher than what he would have had you scale it back, you're still able to give that to him. Also, if the company loses its deductions for portions of the compensation paid in excess of the 280G. Other than that, there really hasn't been any changes with 280G. 162M, pretty simple. It deals with, well, pretty understandable, simple. Deals with publicly held companies, and companies cannot deduct over 1 million if it exceeds over 1 million, and if they're a covered employee. And that's pretty much it, and I will turn it over to Ken.
Okay, thank you, Robert. Just to briefly relate a couple of other developments or pending matters on executive comp. These are, by the way, exclusively for public companies, so everyone else can either have a second cookie or breathe deeply. And by and large, not to public companies that are emerging growth companies. A couple more progeny, by and large, of the Dodd-Frank Act and effect on compensation. Number one, the CEO pay ratio rule is now final and in effect and will require disclosures for fiscal years beginning January 1, 17. So we're already in the effective period. This provision, for anybody who's not familiar with it, is essentially intended to, the cynic in me now talking, generate embarrassing headlines about how high executive comp is. It requires a public company in the following year proxy statement to disclose the total compensation of its median employee, excluding the CEO, the total comp of the CEO, and the ratio of those two amounts. Meaningless from a normal materiality standpoint for us securities lawyers, but essentially, I think Barney Frank and his friends were trying to generate headlines talking about the CEO of company XYZ making 173.2 times or whatever it is the median employee. It is a number that for any company that has had to be dealing with takes inordinate amounts of time to figure out who your median company employee is, especially if you're dealing with foreign operations, part-time employees, and the like. There are huge hopes because of the compliance costs of this that it may be on a tap for deferral or repeal. It actually is specifically on Congress's target list, but my crystal ball is no better than anybody else's on that one. But just a warning: if you're a public company and you have not started your compliance process, this afternoon will be a good time to start. Pay performance. Another disclosure item. It will require a company to provide a table covering up to 5 years of compensation actually paid to the CEO and the average comp paid to other NEO executive officers, and the relationship of those between the compensation actually paid and total shareholder return, and the total shareholder return of the company and its peer group. Again, it's trying to track whether compensation is tracking the performance of the company. Personal commentary, whatever they come up with here, will be an incredibly blunt instrument because compensation and peer performance can be affected by numerous things. There's lag effects, there's dampening effects. It's an interesting and probably laudable goal to make sure that compensation tracks performance, but done with a club versus a scalpel. That is still pending. and no crystal ball on when it would be adopted. Executive compensation clawbacks, again, a pending rule at the SEC, which would then require various securities exchange to adopt specific rules, goes beyond the currently in effect rule requiring clawbacks for CEOs and CFOs for certain financial errors, and would require clawback of compensation for correction of errors in financial statements to the extent that those errors affected compensation. Again, a different definition of all of this than the financial institution rules we talked about before. Okay, again, not in effect yet. However, if you're a public company, you will find that you're already being somewhat judged by institutional shareholders and by groups such as ISS for how your clawback policy works, or whether you have one at all. It's becoming increasingly expected whether or not companies are required to have them. Honestly, I've been generally, initially at least, telling companies it made some sense to find out what the exchanges would rule. That's becoming a little bit less so, but just, perhaps it will be finalized or perhaps it will continue to be delayed. Last point, and just very quickly to allow a couple minutes for time, any public company that is thinking about adopting or amending or having a 5-year 162M renewal vote for equity-based compensation plans, Institutional Shareholder Services, ISS, has tinkered with its guidelines for what it will take to approve. Anybody who works with ISS or deals with them knows that ISS always tinkers with its guidelines every year and always likes to sell its consulting services for how to comply with its tinkered with guidelines. Again, not that I'm cynical. A key takeaway on this, and this is really nothing new, is the ISS employs what they call 3 pillars for judging plans, and you get a total of 100 potential points, and in order for your plan to pass and therefore be recommended for approval, you need 52 to 53 points. Plan cost is 45 of the potential points. Plan cost is determined under a kind of black box, very complicated scorecard by ISS, but if your plan costs too much, you're not going to get approved, and that requires a very complex analysis. The other details are frankly just details, so I'm just going to turn it back to Amy for any questions at this point.
All right, thank you, Ken. We have 2 crystal ball type questions that we'll cover quickly here in the last 2 minutes. One for me and one for you, Ken. I'll start. Do you foresee any changes to Code Section 409A or the 162M rules under the new administration and Republican-controlled Congress? So I think everyone here knows that tax reform is fairly high on the new administration and Congress's list. We've heard Paul Ryan talk about that. We've heard the chair of the Ways and Means Committee talk about it. Definite crystal ball stuff here, but some things that I have seen mentioned, and I think they're mentioned because they've appeared in prior tax reform bills that have not succeeded. A possibility of, so I should back up one step. In order to have tax cuts and achieve them on a revenue neutral basis, something else has to give, and that something else may be in the benefits and exec comp arena. So 2 possibilities in the exec comp arena. There's talk of changing the timing of taxation of deferred compensation to occur when substantial risk of forfeiture lapses as opposed to when payment occurs. This would move everybody to the world that not-for-profit organizations already live in. It would be everybody else's equivalent to Code Section 457F. Basically, once it's vested, you pay taxes regardless of whether you're getting payment at that time. Again, just a possibility. The other is elimination of the performance-based compensation carve-out to the 162M $1 million deduction limit. Now, that would make lawyers' lives easier in many ways because there's a lot of work that goes into making sure that our clients properly fit their comp in those limits, but that would be a pretty significant loss. So we're at 162 6:15, and that ends our formal program. I don't want to keep anyone, so please don't, if you need to go, feel free to walk out. It won't hurt our feelings. And then I'm just going to let Ken take this last question. You can stay for it or not. Ken, the question is, do you have any sense of how soon the Dodd-Frank Section 956 regulations might be finalized or other action taken by the banking regulators?
That's actually easy. No. Now, the less short answer is, to some degree, I'm a bit surprised they haven't taken final action yet. I thought they might try to get that in place before the end of the Obama administration, especially since it's not going to be succeeded by the Clinton administration. So when we scheduled this program, I thought we might be able to say more, but right now, no clue, and I really doubt it's a high priority for the Trump administration to get these in place.
All right, thank you. Well, thank you everyone for coming. We appreciate your time today, and have a great afternoon.